Mark Draper here with Nik Dvornak, Portfolio Manager at Platinum Asset Management. We're talking about Greece today. Now, Nick, the market is incredibly complacent at the moment, or it seems very relaxed about the situation in Greece. Do you think the market's right to be relaxed about Greece, or how do you see it?
Well, indeed they are very relaxed, perhaps surprisingly so, given how much turmoil there was 2 years ago when it seemed like the exact same thing was playing out. Look, so a few things have changed. So what has changed? Number one, the exposure of European banks and other financial institutions to Greece is significantly diminished. This is partly because government institutions like the stability funds have taken on some of that debt from the banks, and secondly because Greece wrote down some of its debt in the past and those banks have already worn those losses. So their exposure to Greece is minimal. The exposures now lie predominantly with the European Central Bank, the ECB, and European governments. As for whether people are right or wrong to be worried, well, clearly they're not very worried at all at the moment. Where you might have some concern is if a Greek default does damage the financial standing of some of the European sovereigns that they owe money to. Or alternatively, you can see Greece is essentially a microcosm for many countries in Europe. And what we're seeing here could play out in other countries. And I think the market is certainly assigning a very low probability to that. If that probability begins to change and increase in investors' minds as we go through subsequent elections in Europe, we could see a period of a lot more volatility ahead.
And we were talking before off camera about the effect of quant easing over in Europe with all of what's playing out in Greece. How does that actually reduce the risk, if you like, of what's going on at the moment?
Yeah, look, so one of the risks, of course, would be that if Greece defaults, they owe $320 billion to investors in their government debt. A lot of those investors are other European governments who have very stretched balance sheets to begin with. So the risk is the investors reassess the financial stability of some of those European countries and are reluctant to lend to them again. Now, what QE does is it creates a buyer of last resort in the form of the European Central Bank, which buys these bonds. And you can see that because even with all the turmoil in Greece, the Portuguese government can still borrow 0.5% cheaper at 10 years than the US government. And they're borrowing in euro, which is a currency investors don't really want to hold. So the US government is borrowing in US dollars. Investors want to hold their currency and they still demand 0.5% more for holding US government debt than Portuguese government debt.
And I think even the Italian government can borrow less than the US government at the moment as well.
That just kind of keeps this downward pressure on bond yields and keeps the pressure off the governments. And so the idea is, well, if they do take an additional loss from Greece, well, this buyer of last resorts just keeps the funds flowing and the market open. And so you avert a crisis in another country. So it stops the knock-on effect.
So quant easing is a positive thing for controlling the situation, but the risks are that politically it could escalate in other countries with extreme political parties getting into power. That would be one of the things to watch.
And that's very much a risk in the background in Europe, right? And you're seeing it in France, you're seeing it in Spain, but also in other countries like the UK, which is a part of the Eurozone, in Italy. So there is that broader risk, and I guess a lot of it depends on how Greece plays out. I mean, if the Greeks leave the Eurozone and as a result all their debts get written off and the economy recovers and they have a weak currency and are able to trade their way out, it might encourage other voters to sort of be tempted to follow the same path. If things turn out really horribly for Greece, it will work the other way. It will push people back towards the political centre and away from the extremes, and perversely it might actually be good for stability.
So it's been controlled at the moment. It's certainly a situation that's worth monitoring from an investment perspective. And Nick, thanks very much for your time and your thoughts today.
Thank you very much.